Good afternoon, everyone. Welcome and thank you all for accepting the invitation at the OTP Bank Macroeconomic Webinar on global and local markets. My name is Alexandru Angel, and I will present this event today, which will last for about 1 hour. So, during this webinar, we will approach the current economic status and context, and also future prospects by sharing important macroeconomic insights with you, and looking at how recent market and policy shifts have impacted the local economy. Before we begin, I have a few notes for you. So today's session is being recorded, and all speeches and presentations will be held in English. Of course, translation is being provided, and for Romanian, please press the translation button on the screen. Please keep your microphones on mute during the event, and if you please, keep your cameras on. If you have any questions for the presenters, please use the chat feature and post the questions right there so that the presenters can answer during the Q&A session at the end of this presentation. Also, please mention which presenter you are addressing the question to, of course. Let me now introduce the keynote speakers. Here with us are Gyula Pater, CEO of OTP Bank Romania, Gheorghe Tardos, Chief Economist, Head of OTP Bank's Research Center, and Mihai Kovac, Economic Advisor at OTP Bank's Research Center. Now, let's please welcome our first presenter, Mr. Gyula Pater. Sir, you have the floor.
Thank you for the introduction, Alex. My part is quite brief, so I just really want to welcome all of you to our quarterly macroeconomic webinar. As you might know from the previous webinar editions, we will spend the next hour sharing with you insights into the economy and the markets. Our goal is to help you understand the current context and make informed decisions about your business and personal plans. Before that, let me also briefly get into OTP Bank's Romania performance this year. As you might know, the sales process we are undergoing has not affected our operations. And as it follows, in the first half of this year, we have achieved a highest profit in the bank's history. In the main business lines are performing well, and due to our investments in the past and the digital developments we are setting daily, weekly and quarterly records in the number of customers choosing to open accounts with us online. So for now, our focus is to continue with the usual course of business. As this webinar also became a tradition, so we continue, of course, which ultimately means understanding the challenges that you face, provide the right tools and expertise to overcome them, and to build our partnership. Which brings me to the purpose to this event, to share valuable macroeconomic insights that will help you to stay ahead of the game. You will see thorough research from our team, and I encourage you to participate actively and ask questions at the end of the session. We are here to provide you with the best possible advice and support. Thank you for joining us today, and let me forward the floor to, the floor is yours, Mishi.
First, before we begin the presentation, we'll have Mr. Mihai Kovac that will give us the context and introduction into the analysis. Then we'll go towards Mr. Gheorghe Tardos, which will present the details about the international environment. And then again, Mihai will give us details about Romania's macroeconomic forecast. So now, if you please, Mihai.
Yes, thank you very much. Welcome, everyone, at this presentation. As you can see, the main message from today's event, compared to the last event when we met, we think that the economic growth situation has a bit more challenging for Romania, not just for Romania, but for Romania as well, as we thought before. So we think that the growth slowdown from 2022 could be more prolonged. We had these ongoing fiscal problems, and probably all of you are aware that there has been some measures that were adopted to correct the fiscal deficit mainly for next year. This will halt disinflation temporarily, and nevertheless, we still think that fiscal risks are still significant in the economy, and these are the most important domestic risk in terms of Romania from a macroeconomic point of view. Just to give you a flavor of the presentation, also in terms of the numbers, so we revised down this year's growth forecast from close to 3% to slightly below 2%, 1.9%. And next year's growth forecast from around 3.5 to 2.7. And the underlying reasons are threefold. First, the incoming data were weaker than we have foreseen before. In particular, the service sector is declining, and the service sector, which made a very strong recovery from the COVID, also weakened by the second quarter, in particular the tourism related and hospitality sector. We will speak about fiscal consolidation. I also mentioned this also has an effect, naturally. So the fiscal policy will subtract 1% of GDP out of the economy to put or to try to put the fiscal situation on track. And the third point, which Gergő will speak about, is that the euro area economy is also weakening, and naturally for Romania, it's an important foreign market. In terms of inflation, we have been through in the last half year a process of strong disinflation. We will speak about in more detail, but we think that early next year, the fiscal consolidation and the recent increase in oil prices will halt disinflation temporarily, which brings us to the key question that what will happen with interest rates. And here the main issue is that probably as the central bank will look ahead at this inflation profile and sees that this inflation will be slower than expected, even halted at the start of next year. We don't expect rate cuts early next year anymore, but we think that rates could be kept, the policy rate could be kept at the current level until the second half of the year, and we expect some rate cuts only in the second half of next year. And still, although there are these fiscal measures I mentioned, we still think that to bring the budget deficit in line with next year's 3% target, further measures would be needed, which it's a question whether they will happen, as we know that there are 4 elections in Romania next year. So probably in political terms, that would be difficult. So we don't expect further significant measures next year. So this was the introduction. And I think Gergely could come up with the global environment.
Hello, good afternoon to everyone. Regarding the global environment, I would say that the picture is, let's say, a mixed bag, because on one hand, economic growth accelerated in the US in the third quarter and also in China. But on the other hand, economic growth remained really weak in the Eurozone. The Eurozone economy is stagnating, and maybe in the third quarter, it could fall into a slight recession. And it also should be, let's say, emphasized that the other large economy, I mean the US and China, is also under pressure, and a significant acceleration in the US and in China is not, let's say, a result of sustainable acceleration in underlying economic activity, but it's driven by fiscal stimulus, because in the US the deficit is widening fast from already high levels to around 7-8% of GDP, which could be labeled as unsustainable on the long run. And this is definitely related to the presidential, so the elections in the US next year. While in China, the government would like to keep the economy above the water because after the reopening, the economy failed to deliver the accepted acceleration because of, let's say, the really deep problems in the real estate sector, and this triggered some fiscal and some monetary loosening, and we can see the fruits of that in the recent acceleration. But the real big picture is that all these economies are under serious pressure. There are in the, let's say, in the slowdown phase when monetary policy, that's true for the US and the Eurozone, is tightening to put back inflation to the target. And this, looking ahead, might slow down the economy further. And let's say the large part of our current problems is coming from the very high inflation last year, which were caused by, as a direct cause, by commodity inflation, because last year, after the reopening and after the war, food and energy prices and also the prices of metals and minerals shoot up and drive up inflation even in developed economies to around 10%. Since then, we could see a correction in metals and minerals and also in food prices. Nevertheless, in the last few months, the prices of these commodities will remain more or less flat. However, in energy, where we could see the largest spike last year, and the very drastic correction after that, prices also started to increase recently, partly because of cut back supply in oil, and also because the tensions in the Middle East. Gas prices, which fell 90% from the peaks of last year, picked up to around the level of 50 euro per megawatt hour, which is, let's say, 20-25% higher than the level which is considered to be the long-term equilibrium. And regarding oil prices, the last 3 months resulted in a 20-30% increase, and this was caused by the pact of Saudi Arabia and Russia to cut back supplies. And of course, on the short run, even if these increases are very, let's say, modest compared to what we could see in 2021 and 22, but these increases could put some upward pressure on inflation on the short run. And why so regarding inflation, this temporary pickup in energy prices will, let's say, result in a temporary stop in this inflation, because while inflation went up drastically in 2021 and 22, reaching very high levels which haven't been seen in the last 4 decades, in this year inflation fell relatively fast and moderated from 10% to around, let's say, 4% in developed economies, both year-on-year terms and if we check, let's say, the monthly repricing and try to figure out how much inflation that would result in a 1-year horizon. So all these figures are went down to 4, which are, so this 4% inflation is of course much lower than what we had 1 year ago, but it should be kept in mind that it's still significantly higher than the 2% inflation targets in the Eurozone and in the US. And the tricky part comes looking ahead, because the big question, how fast inflation will go back toward the targets. And here we have a serious problem. I mean, unemployment is at a historic low everywhere in the world, or let's say 90% of all economies. And this put pressure on wage growth, and high wage growth put pressure on service inflation. And this is the tricky part, which could keep inflation above the target for a while. And this is a main headache for central banks. And this is why in the last, let's say, few months, central bank warned markets that they will keep monetary conditions tight, and markets started to price the higher for longer scenario, which means that central bank will keep the key interest rates at the current high levels for a while, and only will start cutting rates in the case when they are really find the evidence that inflation is converging back to the target. And this is what drove up long-term yields also at historic levels, together with the fact that the US deficit is really high, and this means that the supply of long-term securities, let's say risk-free securities, reached very high levels recently. And regarding the growth outlook, I would say that despite the recent acceleration in economic growth in the US and in China, the outlook is far from being relaxing. Looking ahead, the Eurozone economy will remain under pressure, and economic growth could remain somewhere below 1% next year. In the US economy, according to expectations, the fiscal stimulus is coming to an end, and this will lead the US economy to slow down, and according to expectation, US economic growth will reach only 1% in 2024. So the markets which are, let's say, important for the global sentiment and also for the demand for regional exports will remain really subdued, and economic growth looking ahead will remain weak in the Eurozone, and that's the main factor for Romania. Thank you, Mishi. Oh, sorry. Finally, regarding inflation, after a temporary stop, inflation is expected to moderate further next year toward the target, but it could reach the target zone somewhere only at the end of 2024, and risks are still tilted to the upside. Thank you.
Thank you very much. I would move on to the local economy part. So in terms of the real economy, we had the second quarter GDP data release. In fact, it was already a detailed release after the flash. And the year-on-year growth rate, so compared to the second quarter of 2022, there was only a 1% growth in Romania, which, well, compared to some economies where there's already a recession, it's not bad. But if you look at this black line in the previous quarters, you can see that there's a very obvious slowdown. And what drives this slowdown? If one looks at the details of which sectors contributed to the most, one is industry, which is this orange color. So its negative contribution has increased from Q1. And the other is the service sector, in particular the wholesale, retail, transport, hotels sector part of services. The other private services, especially related to the IT sector, are performing well, and also other professional services. But this sector, which is in green, this HoReCa sector, which made a very decent recovery after the COVID, it started to weaken as real income, real wages have been declining in the first half of the 2023. And we have data up to August, monthly indicators on economic activity. We don't have the Q3 GDP yet. It will arrive somewhere in November, mid-November. What it shows actually that for Q3, one shouldn't expect a strong turnaround in activity. So most of the trends that were prevalent in Q2, they remain in Q3. So industrial production kept declining at a pace around 5%. If you look at the details of industrial production, I would say that apart from the automotive industry, most second and some smaller industries, most sectors are in red, so it's relatively widespread. The service sector monthly indicator is also in minus. We have to be careful because it has some limited correspondence to the GDP service sector, but nevertheless, the trend is obvious that there's no improvement in private services. And what clearly kept up GDP also in the first half of the year, and this could even improve for Q3, that's construction. So it's the investment in buildings. And it's not related to the real estate sector, but rather it's related to infrastructural spending, and then a large chunk of these are from EU fund sources. And the retail trade is still in the positive territory, but its pace of growth is also diminishing. So all in all, based on the incoming data, we don't expect a turnaround or a sharp turnaround in activity for Q3. Some improvement in the year-on-year figure could come, but not very significant. This is why we revised the annual GDP growth outlook for this year downwards. If you look at the labor market, and Gergely partly mentioned in a global context, what is true for most European economies, it's also true for Romania, that the weakening of economic activity is not really visible so far in the employment and unemployment figures. At the beginning of the year, there was some slight increase especially in the registered unemployment rate, and there was some flattening in employment, but then it turned back. So it's an open question whether this can prevail. We can ask the question why this could happen, so that there hasn't been a significant reaction of the labor market to the weakening activity. One explanation lies in the fact that the employment is usually a lagging indicator compared to output. But the other is that actually, as we discussed before, in the second half of last year and first half of this year, there has been a significant real wage decline because of surprise inflation, and as companies would partially compensate their higher energy costs through lower real wages, they were less forced to adjust on the employment side. So should the activity weakening prevail, there could be some employment effect, although as you could have observed in the beginning table, we don't expect recession for Romania, so we don't think that there should be a material increase in unemployment. According to indicators of labor market tightness, it seems that the labor market is still tight, meaning that labor demand is compared to the number of unemployed is relatively solid. The black figure shows the hard data, so job vacancies to unemployed. The red figure shows the survey measure, which deviating a bit from the black line, but nevertheless, both of them are showing that there's no significant easing of the labor market, which is consistent with what is said regarding employment. Sorry, there were some noises, hopefully not from me. The other chunk of the labor market we have mentioned, it's what happens with the wage front. So wages have been increasing around 15%, relatively stable. There has been in the recent months some changes that there has been some slowdown in private wages while pick up in government wages, which were freezed before. But the general picture is that national economy wages are growing around 15%. And this means that as inflation is coming to single digit, real wage growth from, let's say, somewhere in June has started to move to the positive territory, and recently around 5%. And this you can see this in the red line on the chart. And this is something which could act as a factor of recovery looking ahead if people will have more purchasing power to spend. Regarding the other sector of the economy, on the budgetary side, there hasn't been much news regarding incoming data. So while originally this year's deficit target was 4.4% of GDP, the deficit seems to trend towards 6% of GDP. And without significant consolidation measures for this year, this can be roughly the end-year deficit, maybe slightly lower. In the meantime, what happened that the government raised the 4.4% deficit target to 5.5%, to our understanding in agreement with the European Commission. And they promised to have some end-year spending cutbacks on investment and on other expenditure items, but this will not bring a major turnaround this year's deficit. For next year, the story is a bit different, because we have so the government has adopted, you might all know, mostly revenue measure, tax measures around 1% of GDP, even slightly more. These measures are partly related to indirect taxes, VAT hikes, excise duty hikes, also some minimum profit tax or turnover tax was introduced, also some tax exemptions for the IT and the construction sector were closed, and also for micro enterprises there some new taxes were introduced. All this will help to bring, let's say, the deficit to around from 6 to 5%, but we still think that this is not enough to bring the deficit to the government's original next year target, which is 3% of GDP. So there's roughly a 2 percentage point gap, and we don't expect further major consolidation measures because of the 4 elections that are coming. But how we understand the situation is that although next year the European framework for fiscal rules will bind again, you might remember that they were suspended during the COVID and the energy crisis time, so they seems to bind again next year. But our understanding is that probably for starting relatively high deficit, countries might be allowed to bring the deficit back to the 3% target by 2025. So we don't expect a major negative effect or suspension of EU funds or other measures from the European Commission side, due to the fact that if Romania misses the 3% deficit target for next year. Moving on to the inflation front, this has been a relatively success story in the last half year in Romania, just as elsewhere. So from a peak around, the peak was even above 16%. We know the latest data for September, it's 8.8. And you can see the headline number, that's the red line, but the green line, which is the so-called median inflation, which shows the trend type price pressure, so the general price pressure, what's in the economy, it is also coming down. And if we look at more short-term based measures like 3 months changes, just like Gergely described in case of the euro area and the US. So the price increase in trend terms in Romania around 6-7%, which is still relatively high compared to it's coming down, but it's still relatively high compared to the 2.5% target of the Romanian Central Bank. Furthermore, another interesting element is that if you look at the survey measures, which are the red lines on these charts, the upper chart, you can see the service sector pricing intention in red and service sector inflation in green. In the lower charts, you can see the non-food goods inflation and pricing intentions. And you can see that after a big decline, the declining pricing intention in services has stopped or halted, and in the non-food goods sector, it even turned back slightly. So all this means that the pace of disinflation seems to slow down. We expect the end year inflation around 7.5%, which is still coming down from 8.8, but let's say in 3 months, which is not a very quick pace. And furthermore, we think that due to the tax measures introduced, understandable to consolidate the fiscal affairs, and also on account of higher fuel prices, which Gergely described recently, we think that the January inflation rate would be slightly higher than the December, above 8%. So there will be a halt in this inflation, and we don't expect even the end year 2024 inflation lower than 6%, which means that although this inflation is ongoing, its profile has shifted upwards, and it's slower than could have been envisaged before. And all this has some consequence naturally for monetary policy. We could all observe that the policy rate of the Romanian Central Bank has been kept constant since January, when it was raised to 7%. And also, if you look at the 3-month ROBOR rate, which is if you compare it to the policy rate or the overnight rate, you can deduct some expectation of rate changes for the next 3 months. You can see that it came down the end of last year, early this year, but now it's also freezed, like around 6.4%. The overnight rate is around 6%, which means that basically the market doesn't really expect in the short-term horizon rate cuts. And even the communication of the central bank, at least what we heard, seems to suggest that the slower pace of disinflation could postpone rate cuts. And this is why we now expect that the rate cutting cycle could start in the second half of the year earliest. Furthermore, it's not only inflation that the Romanian Central Bank should take into account, but also the risk premium towards Romanian assets. And in this respect, the recent developments are also not positive. You might remember that Gergely described this higher for longer interest rate story for the euro area and the US, and the increasing long-term yields. All this international development also appeared in Romania, and let's say compared to July, there has been a 60-70 basis point increase in the 10-year yield of local bonds. So in this sense, the risk premium to Romanian assets became higher, and this is also something which makes the central bank more cautious. And finally, a few words I would speak about the banking sector activity, because it's also an important element of the growth performance. So the loan growth continued to weaken. This is also consistent with the weakening GDP growth. Nevertheless, we can admit that especially for this purple part, this corporate loan growth, that was extremely high last year. So there were some big ticket items. So it's understandable that it slows. But if you look at the household sector, the housing loans have completely stopped growing. In fact, there's a small decline. And the consumer loan growth, after some slowdown, started to recover, but relatively modestly. So these indicators are also something which point to a prolonged weaker economic growth. We can look at this from another angle. If you look at the net credit generation in the economy to GDP, we can also see similar trends. The corporate activity is somewhat lower than last year. The consumer loan activity it's partly recovered, and the housing market activity is very weak, this latter is consistent with the declining house prices and weak housing investment in Romania. So I think this was my part here, our main numbers and messages once again. And I would give back the microphone. Thank you.
Well, thank you, Mihai. That was very interesting. Thank you for all the information, the insights. Before going further, let us answer a few questions from our audience today. First of all, regarding the inflation, which is the most important subject, let's say, of the last few months, is it possible that in January this inflation trend will reverse and let's say we could see inflation on the rise again, not just the disinflation process stopping? And if so, what would determine this? What would be the main factors that will aggravate the situation?
Yes. As I mentioned when discussing these charts, I know maybe the details of the figure are a bit small, but there are some fuel price base effect, which is, let's say, quite certain that will come as working against this inflation. And the other part of this inflation is slightly more uncertain in magnitude, but not uncertain in terms of the direction, that all these indirect tax hikes will be added to the prices of goods. If you think about different drinks with high sugar content, or some parts of services where the VAT the decreased VAT rate will increase, or if you think about a more indirect effect with this turnover tax. So companies will be forced to at least pass over a part of the effect of turnover tax in terms of higher prices, if they don't want to lose profitability fully. So these are the two factors: the fuel prices, actually, which is a bit a smaller element, like just a few 0.23 or something like that, and a somewhat bigger effect of coming from the taxes. But, you know, as I said, we don't expect, like, we have the January inflation around 8.2 or something like that. So it's not I wouldn't call it as a full reversal, but at least not just something that, that this inflation stopped for a moment. So I think there will be a few months until we achieve again this 7.5, which is expected for the end of this December.
All right. So these are the main factors.
Just one thing which if you let me, I would add. So it's very clear that Romanian processes won't result in a reverse in this inflation. The main factor, which is, let's say, is a global threat, that in case of escalation of the situation in the Middle East, energy prices could soar again. And let's say this is much more a global factor and not a Romanian one. And the probability of such a situation is definitely higher than zero. So this is a global fear that in case of escalation, For example, if there would be a war between Iran and Israel, that could result in going energy prices are ballistic, and this can. So in that case, we can see a new global inflation shock. This is not the most likely scenario, but it cannot be ruled out. So that's some kind of let's say an external threat to Romanian inflation. But this is not only for Romania, but in that case, of course, regional and European inflation will go up again.
All right. So we spoke about energy prices now, and especially about the oil prices, which are definitely on the rise. We can see the graphics and the trends everywhere in the media. What about the gas prices? Is there any chance that let's say we can encounter a situation like in the previous years, where in January, February the prices spike up?
Oh, well, I would say that the probability of such a situation, so this is unlikely. So right now, gas storages are fulfilled. Alternative supply routes are working, and Europe is much less dependent on Russian gas than it used to be. However, these Middle East tensions are dangerous because Europe is receiving gas also from there, and in case of, let's say, a war, supply can be more limited. So that can put some further pressure. And LNG markets are totally global. I mean, for example, if there was some strike in Australia that resulted in increase of European gas prices. So it's very clear that, let's say, the situation is tense. I mean, Europe is using a lot of gas in the winter and has not enough supplies. Europe is importing a lot of gas from external sources, and the European gas markets with less Russian gas in the system is more fragile. So we can see spikes in gas prices, but the probability of such an event that we could see in 2022 is still very, very low and close to zero. I think that we might see prices going up, let's say, above 50, above 70, above 80, but I do not think that the situation of last year could be repeated.
All right. Thank you, Gergely. So bottom line, everything is connected, so we should watch out for everything that's possible, mainly. Let's go back a little bit to the local setting. Let's talk about the key interest rate a little bit. When do you think the first rate cut by the NBR will take place? And maybe if you have an estimate for the key rate by the end of next year.
Yes. So, well, in terms of the numbers, you can see that for next year we expect the key rate at the end of next year at 6.5, which is actually much higher than now what is now the market consensus, which is 5.5. This is presumably because we don't expect rate cuts in the first half of the year. At some stage, if I can remember well, the governor of the central bank said that they might start thinking about cutting the rates once the inflation is at the level of the policy rate, which we know is 7. So the question is when inflation will be close to 7%, and I would say this is already next summer somewhere. And furthermore, as I mentioned, since this governor's statement or communication, global developments pointed to higher interest rates, so higher risk premium toward Romanian assets. So there are other reasons, also global factors that might make the policymakers at the central bank to be more cautious. So this is the reason that we have moved to a relatively limited rate cuts in the policy rate next year.
All right, all right. And nevertheless, even though the benchmark rate won't be adjusted, let's say, in the first months of next year, you do expect, let's say, for the loan market to have a comeback, at least for the personal loan segment, right? Because you estimated like a growth of GDP for next year, which is based mainly on public consumption, right?
Yes, I mean some recovery in the loan market is also expected with higher GDP growth, but as a baseline, one important source of consumption growth is not necessarily the loan market, but rather the growth of real wages. So we expect consumer prices around 7%. And wage growth around 11.5. Here I would mention actually that there's this October minimum wage, and it's expected that from January there could be another minimum wage hike, which also has a spillover effect on the whole wage distribution. So an important part of the consumption growth will also come from real wages, or the most important, I would say.
So a couple of months after the let's say the January base salary adjustments, let's say 2 months later, we should see some effects in the economy.
Yes, definitely. Yes.
All right. One more question about the GDP for this year. Are there any changes, maybe surprises that could lead the GDP higher in the last 2 months of the year? Something that would help it to recover some of the growth it didn't have in the previous months?
Probably one element could be investment and construction, which is a very volatile item in activity usually. And we all know that the disbursement of EU funds in Romania are coming well, and also the confidence indicators in construction are relatively solid. Well, it can turn out that we have relatively poor, to admit we have relatively poor complementary indicators for the service sector. So it can turn out that the service sectors perform somewhat better than we expect, especially that there's some contradiction between the private, so the individual services, and the business services. So the business services are still growing solidly, like this IT-related and other professional services, and as I mentioned, this hospitality and tourism related services, they are weakened substantially. So from this setup, maybe there can be upside surprises, but generally we feel that the trends are rather not positive, but rather point to a weaker activity.
I see. One more question, one final question from our audience. You mentioned investments earlier, and the fact that investments contributed in a much larger percentage than before this year to the GDP growth and development. Do you expect this to happen again next year?
Well, you can see it on the table that we forecast some slowdown in investment because of let's say the corporate part, which is more related to financing cost and the outlook and all these things are probably as the international economic environment is not that positive. This can weaken slightly, but on the other hand, this infrastructure investment part, it could remain very solid. And this is why, although we expect some moderate slowdown in investment, it's still 6.5%, which is well above the GDP growth, what we expect for next year. So in this sense, this will remain to some extent. That's true.
So that's a great encouragement, let's say, seeing investments carrying on from year to year,
yes,
and maybe helping the local economy develop a little bit more than previously.
Yes. In fact, like Romania is receiving a substantial, like on average, like more than 3% of GDP EU funds, which is in this new financing cycle. If I add up all the incoming or the potential incoming EU funds, and naturally this is an important source of financing and investment activity.
All right. That's good news. Mihai, thank you. Gheorghe, thank you. Gyula Fater, thank you also for your words today. Also, thank you for being a great audience and having great questions for us today. And one last question. Let's take this one too, if you have the time. How do you see the mortgage loan sector in 2024 in Romania? Will the demand regain traction in the first half of the next year?
Well, I don't know. Gyula, will you answer or shall I say?
Yeah, I'm trying to do so. We expect quite a slow recovery in terms of mortgage lending. So that's definitely linked to the interest rate. And once it's been said that most probably the first signals will be done the rate cuts will be done in next summer. So this is probably the signal for the market to not the market, for the people to take more loans. So the recovery until the mid of next year, it will be quite insignificant. After that, maybe in higher speed.
So let me carry on this question. And is there a trend among consumers, let's say, to restructure, to let's say refinance their current loans?
This is happening, yes. But I think it's already been also all the opportunities where it was a room to maneuver for certain loan holders. It was already been used, but we see that this market is also slowing down. So since the interest rates are not moving too much, it doesn't really make sense to refinance because no significant gain can be achieved. So this part of the mortgage market is also slowing down.
All right. So thank you for this information, for all the explanations and future trends. That was the last of the questions from the audience. Okay. If anyone has any further questions and they would like to address them later, we are open. You can send them via email towards us and we'll do our best to answer properly. Once again, thank you to our presenters today, Gyula Fater, Mihai Kovac, and Gheorghe Tardos. Great presentation. And let's see these trends come to life then in the next month.
Thank you.
Thank you.
Thank you.
Thank you.
Bye-bye.
Thank you. Bye.